Hey everyone, it's RMX and welcome back to the channel. Today, we're diving deep into one of the most influential books on investing ever written, The Intelligent Investor by Benjamin Graham. This book is practically a rite of passage for anyone serious about building long-term wealth in the stock market. We're talking about the fundamental principles that can help you weather any financial storm. Now, Benjamin Graham wasn't about chasing quick profits or timing the market. He believed in a rational, disciplined approach to investing. He wanted you to understand the businesses behind the stocks you own and to buy those businesses when they are undervalued. That's what we're going to be breaking down in this video. This book is packed with timeless wisdom, so we're going to cover the key takeaways that can help you become a more intelligent investor. Make sure you stick around until the end, because I'm sharing my personal thoughts on how these principles can be applied in today's market. Let's get started. Right off the bat, Graham wants to make sure you understand the difference between investing and speculating. And let me tell you, this is something people get wrong all the time, especially now with everyone trying to make a quick buck in the market. Investing, according to Graham, is all about thoroughly analyzing a company, understanding its intrinsic value, and aiming for long-term growth. Think of it like buying a house. You're looking for something that will appreciate in value over time. Speculating, on the other hand, is more like gambling. It's trying to predict short-term market fluctuations, hoping to make a quick profit. Now, there's nothing inherently wrong with speculation, but it's important to recognize that it's not a sustainable way to build wealth. It's like flipping a coin. You might get lucky a few times, but eventually, the odds will catch up to you. The problem is, a lot of people think they're investing when they're actually speculating. They're chasing hot stocks, following the latest trends, and letting their emotions dictate their decisions. Graham wants you to avoid that emotional roller coaster. He wants you to be a business owner, not a gambler. This is about being disciplined, doing your research, and making calculated decisions based on logic, not hype. Remember, slow and steady wins the race. Now, this is where things start to get interesting. Graham introduces this concept of Mr. Market. Imagine Mr. Market as this emotional dude who shows up at your door every day trying to sell you pieces of businesses. Some days he's super excited, offering you sky-high prices. Other days he's totally bummed out, practically begging you to buy his shares at dirt-cheap prices. The thing is, Mr. Market is driven purely by emotions, fear and greed mostly. He doesn't always have a firm grasp on reality, and that's where you, the intelligent investor, have the advantage. See, you're not obligated to buy from Mr. Market every day or even every month. You get to decide when the price is right, when a business is truly undervalued, and that's when you strike. This concept is all about recognizing that the stock market isn't always rational. There are going to be times when prices are inflated and times when they're depressed. Your job is to not get swept up in the hype or despair. Instead, you wait for those opportunities when Mr. Market is practically giving away bargains, and that's when you make your move. Okay, let's talk about one of the most crucial concepts in value investing, the margin of safety. This is like the golden rule that separates the amateurs from the pros. Imagine you're buying a used car. You wouldn't just pay the asking price without getting it checked out by a mechanic, right? You want to make sure there are no hidden problems, that the engine's in good shape, and the car's worth what you're paying for. The margin of safety is your financial cushion. It's the difference between the price you pay for a stock and the actual intrinsic value of the underlying business. By buying a stock at a significant discount to its intrinsic value, you're protecting yourself from potential losses. Even if your analysis is slightly off or if something unexpected happens, you've built in that buffer to absorb the shock. Think of it like this: the bigger your margin of safety, the lower your risk. And in the world of investing, managing risk is absolutely crucial. It's not about avoiding losses altogether, it's about minimizing your downside, so that when you're right, you win big, and when you're wrong, you don't lose your shirt. Remember, in the stock market, sometimes the best investments are the ones you don't lose money on. Now, Graham knows that not all investors are created equal. Some people are perfectly content with a more passive approach, aiming for steady, long-term growth. Others are willing to put in more time and effort to potentially achieve higher returns. That's why he outlines two main types of investors: defensive and enterprising. The defensive investor is all about minimizing risk and preserving capital. They prefer to invest in established, blue-chip companies with a proven track record of profitability. They're not looking for the next big thing, they're looking for stability and consistent dividends. Think of this as the set it and forget it approach to investing. The enterprising investor, on the other hand, is more hands-on. They're willing to dig deeper, analyze businesses, and potentially invest in undervalued or overlooked companies. They're not afraid to roll up their sleeves and do the research. Now, with this approach comes potentially higher returns but also higher risks. The key here is to identify which type of investor you are. Are you comfortable with a more passive approach? Or are you willing to put in the extra work for potentially greater rewards? There's no right or wrong answer, it's all about finding the strategy that aligns with your risk tolerance, time commitment, and financial goals. Let's face it, the stock market can be a roller coaster ride. One minute it's soaring to new highs, and the next, it's plummeting faster than you can say margin call. And during those volatile times, it's easy to get caught up in the emotional frenzy. That's why Graham dedicates an entire chapter to market fluctuations. He wants you to be prepared, both mentally and financially, for the inevitable ups and downs. The key takeaway here is to not panic. Remember Mr. Market from earlier? He's an emotional wreck. When the market crashes, he's running around like the sky is falling, practically giving away his shares. That's your opportunity to buy quality businesses at a discount. And when the market is euphoric, Mr. Market gets greedy, and that's when it's time to sell. Remember, the stock market is a tool for you to build wealth, not a casino where you gamble it away. Don't let fear or greed dictate your decisions. Stick to your investment strategy, focus on the long term, and remember that market fluctuations are inevitable. It's how you react to them that will determine your success as an investor. We've covered a lot of ground, but there are two more crucial ingredients we need to add to the mix: discipline and patience. These are the hallmarks of a true intelligent investor. See, investing isn't about getting rich quick. It's about building wealth gradually, consistently, and over the long term. Discipline is about sticking to your investment plan, even when things get tough. It's about not getting swayed by the latest hot stock tip or the fear of missing out. It's about tuning out the noise and focusing on your long-term goals. Remember, the market is always going to be volatile. There will always be another crisis, another recession, another reason to panic. But if you have a solid plan and the discipline to stick to it, you'll be able to weather those storms. Patience is equally important. Building wealth takes time. It's not a get-rich-quick scheme. It's a marathon, not a sprint. Don't expect to get rich overnight. Instead, focus on making smart investment decisions, reinvesting your earnings, and letting the power of compounding work its magic over time. Remember, Rome wasn't built in a day, and neither is a solid financial future. The Intelligent Investor isn't just a book about investment strategies, it's a roadmap to financial freedom. It's about shifting your mindset from speculation to ownership, from short-term thinking to long-term vision. It's about understanding that the stock market is a tool to be used, not feared. If you take away just one thing from this video, let it be this: invest in yourself, invest in your financial education, invest in your future. The more you learn about investing, the more confident and in control you'll feel about your financial future. Don't forget to smash that like button if you found this video helpful, subscribe for more videos on investing, personal finance, and building wealth, and let me know in the comments what you thought of The Intelligent Investor, or what book you'd like me to cover next. Until next time, take care.